Welcome. My name is Len Lane, and I am the founder and president of Brokers for Life, Inc., and we are Dominion Lending Centers in Western Canada. The topic of our podcast will be about what we consider to be real-life mortgage solutions. Today, we're going to talk about mortgage renewals. Here's the bad news. 85% of Canadians will auto-renew their mortgage and never check to see if there's a better option for their payments or their interest rate. We accept what the bank sends to us and consider that to be their option. The options are only ever going to be in their favor and not yours. There's a stat that says 6% of mortgages are up for renewal over the next 3 years. It's not a number that should impress anyone really, given that Canadians prefer the 5-year term over any other term. And in any 5-year stretch, 3 years of mortgages would be 60% regardless. The number that is impressive, though, is that there is close to $900 billion of mortgages that are coming up for renewal in the next 3 years. That's almost $1 trillion in mortgages. And some of them are going to see increases of up to 3 or 4% because of the low rates that we had during the pandemic. Those rates are also now being affected by the Bank of Canada increase. So variable rates and adjustable rates mortgages are going to be higher than fixed rates, and that has only happened 4 times in 40 years. And this time, it's becoming the longest stretch in mortgage history. This is going to affect the mortgage renewals, and here's why. The bond market, also affected by the increase in the Bank of Canada, responds to the 1 to 5 year fixed rate mortgages are part of that bond market. 5-year bond this morning is at 3.5%. Mortgage rates on a 5-year fixed are just under 5%. But what that also happened is that the 1 to 4 year rates are higher than the 5-year rate, which is caused by the inverted bond yield, which I'm sure you've heard of. The 1-year rate this morning is almost 7%. Variable and adjustable rates are tied to the Bank of Canada rate, which in turn is tied to prime. Prime is 7.2%, and even with a discount of 1.25, which was available for some time for insured mortgages, you are still at 5.95%. What the lenders are offering on insured is prime minus 0.9 or 6.3. So there's a risk that if you're taking a variable on your renewal, that it could be considerably higher than the fixed rates for quite some time to come. Let's go back and talk about variable rate mortgages. It's a common term used to describe 2 types of mortgages, which are quite different. Variable rate mortgages, the payments stayed the same throughout the rate increases. What happened is how much you were paying to your principal and what is being actually applied to your interest each month. As rates increased because of the mortgage, they saw equity decrease and their amortizations increase as they paid down less principal. This, of course, is a favorite mortgage of rental properties and is part of the increase in rental rates. Sooner or later, the bank is going to say to them, increase your payment or make a lump sum to bring the amortization back in line. Most people would increase the payment because they don't have the money to make a lump sum. Adjustable rate mortgages, on the other hand, saw their rates increase and the payments increase as the Bank of Canada increased with it, right? They did not lose any amortization in their mortgage. Their payments went up and their payments will come back down as the Bank of Canada finally gets around to lowering the rates. So what does it mean for renewals? If you have a variable rate mortgage, you may not be able to switch it or move it to another lender. There's a good chance that because your amortization is so out of whack, that you will have no choice but to re-sign with your existing lenders. Adjustable rates, on the other hand, will have that option to change to a fixed rate, or if they're insured, accept the prime minus 0.9% discount and wait out the rest of the changes in the Bank of Canada. So, what is good news? There is good news for insured mortgages as well. Those who put less than 20% down 5 years ago now requalify without using the stress test. Stress test is basically taking the mortgage rate being used, say it's 5%, and add 2% to that to make sure that the debt servicing doesn't exceed the insurer's guidelines of 44% and 39% gross. That's another conversation as well. It will give a lot of first-time buyers an option to moving their mortgages and not be trapped with their present lender. Uninsured mortgages, on the other hand, were dealt a blow by OSFI in March when the Competition Bureau said it was not fair that uninsured mortgages holders still had to qualify at that stress test at renewal.
OSFI said that's too bad and did not change the rule for uninsured mortgages, which are carried on the bank's balance sheets. If you refinanced or have a rental property, they are uninsured mortgages. Just to confuse the matter more, if you have a mortgage with more than 20% equity and you can qualify at the insurable mortgage rate, i.e. the stress test, you can get that lower rate on that mortgage. There's a whole nother conversation we'll have someday about insured, insurable, and uninsurable mortgages, but that's not for today. Do you have a property that was bought as a principal residence, but then turned into a rental? Was that bought with less than 20% down and insured? We have lenders who will accept that as an insured mortgage and allow us to switch them to the portfolio at insured rates. The predictions for the next 5 years show uninsured rates staying above or near the 4.5% range. So that means that the insured rates are about 0.4% lower usually. So we'll be just above 4%, foreseeably right till the end of this decade. So there's a long stretch ahead of us. Of course, you got to remember, but these are predictions by economists who are right about 50% of the time, kind of like the weathermen of finance. What are the steps to get ready for your mortgage renewing, possibly changing lenders? We've made it easy for you. You get a copy of the final payout 120 days before the renewal date so we can lock in rates. Our lenders will honor rate drops if they go down in that 120-day period. Lenders are sending these notices out at different times now to try to maximize their rates in their favor. The lenders we are using for renewals will automatically allow us to float down the rates right up until your renewal. The copy of the property taxes, make sure that they're up to date. If you don't have a copy, we can maybe get them for you from a city or municipality that you live in. Bigger cities, a lot easier to do. Smaller communities or municipalities, sometimes a little harder, but you will need a copy of that. Copy of your home insurance to show it is current. And if it does expire before the renewal date, you'll just need a binder letter from your insurer. You'll need a letter of employment in the last 30 days, current pay stub, and at least, or the last one for 2023 or your T4, just to show what last year's income was. Fill out our secure online application, the website, so that you have updated information. Go to brokersforlife.ca, bottom of the page, there's a long form. Then wait for my team to work their magic and find the best rate options for your current situation. Happy renewing, everybody.
Thanks for listening today. I hope you found the information that we provided to be useful in your mortgage journey. And remember, you can always find our associates at www.brokersforlife.ca/associates. Have a great day.